I think some of them are recovering. I expect probably higher PMIs by the end of this year than we started the year at. And I think some of those more cyclical things could follow that. So I think that question of slowdown versus not slowdown is very sector specific. I think instead it's more of a rotation, a reacceleration, some of those things, even as some of those bigger tech things, do slow down.
I think the slowdown may or may not affect sentiment. What do you think? Do you think risk on sentiment, which has obviously been the case for the last 6 months, could reverse over the course of the year?
So I do, but I think that even some of the action we've seen is indicative of not super bullish sentiment. People don't pile into Costco at 50 times earnings necessarily purely out of bullishness. Some of that is because it's actually a form of defensiveness. It's saying, I don't really want to own bonds per se. I want to buy a really blue chip company and I'll crowd into that rather than owning any of the things that are more cyclical, the energy names, the banks. That's the capital flight out of there, I think, has been indicative of risk off behavior. And so I don't view that the current period we've been in as super risk on. And instead, it's more indicative of fiscal dominance, indicative of how many other areas are perceived as non-investable for many of these while you own it.
You mentioned commercial real estate, something we should stay away from even today in April 2024. Why is that?
Well, I think if someone is a professional commercial real estate investor, I think that there are going to be opportunities, right? Obviously going to be bargain hunting, like super cheap opportunities. But in general, I think we're seeing just an ongoing slow motion train wreck in commercial real estate. I think there are more losses coming. I think that lenders that are heavily exposed to commercial real estate are likely to continue having problem. I would say a lot of that's already priced in. A lot of that, a lot of those things are already super cheap. Capital, it's a very well known theme at this point that commercial real estate's in trouble. And I think that a theme I've been making is that so many people keep saying that commercial real estate is going to drive the next recession. Whereas what I've been pointing out is even the bearish assumptions are looking at, say, like 1.5 trillion in equity wiped out of commercial real estate. Whereas if you look at fiscal deficits, they're over 1.5 trillion per year. And overall household net worth is something like 140 trillion and rising at all-time highs, right? So there are these because the front end's cut or because the long end rises a little bit or a mix of both. And so the overall risk reward of the long end is still not super attractive to me. To the extent that I like bonds, I either like T-bills or I like intermediate term tips, for example. I don't particularly like the long duration bonds, which is not to say that I don't think that they will, it's not that even if they squeak out gains for the year, for example, there are much better other assets that I'd prefer to own from a risk reward standpoint. I prefer to own things that I view as asymmetric, meaning that the downside is relatively contained, whereas the upside has a lot of room to go. And I don't view the bond market in that situation. I wouldn't be surprised if we see yields higher or lower by the end of this year, but it doesn't feel like it's weighted toward a kind of a strong long outcome. So it's just an area that I kind of put into the too hard pile and say that it's not a lot of opportunity for the amount of risk I take on.
So if you expect the yield curve to steepen, I'm assuming then you expect the long end of the curve to continue going up, even if the Fed cuts, which would bring down the short end of the curve. Is that correct?
Yeah, or it stays sideways while the Fed cuts the short end. There's a couple of different ways and magnitudes that could happen. And to the extent that long end yields stay higher than expected, that could put lag. I do think if we see a continued PMI upcycle, that could come with a little bit of inflation. So it's not like I'm forecasting inflation to quickly retest the highs we saw, a couple of years ago. But I do think that the Fed's it's going to be sticky. It's going to be basically inflation's not going to go down to the Fed's target as quickly as they'd want it to. And that inflation, I think, is going to hover 3% or higher, most likely. And I think the key thing to watch to see if it can go much higher than that is energy. I expect rent inflation to kind of stabilize, not really trend lower, but not necessarily explode higher either, because there's a lot of supply coming online. But it's really the energy markets that I think are worth watching to see if we end up having above inflation that's even above kind of current levels that are already elevated relative to targets.
So the Fed, how would they respond to this stabilization of inflation, you think?
I think neutrally. I think that they already kind of realize that their tools are not necessarily well positioned to deal with this. So when I talk about fiscal dominance, what I refer to is when we look over the, let's call it, I did charts on this. Like for example, the past 70 years, if you look at where most credit creation happens, higher interest rate pressures on the private sector, mortgage rates and corporate bond rates and things like that. So I do think that they might start targeting curve steepening. But I think it's mostly about just expectation management. I think they're going to be relatively neutral, even if inflation reaccelerates. And I think it's going to be an ongoing kind of narrative issue for them.
Suppose energy moves up and accelerates there and brings inflation up with it. Do you think the Fed may respond by raising rates again?
So it's possible. My base case is they would first focus on higher for longer rather than raising rates, because I actually think that the raising rates beyond a certain point can actually be stimulatory. That's the challenge you face in a fiscal dominant environment. So if most of the money creation was happening because of the private sector, then higher rates would generally be not stimulatory. The opposite, it would be depressionary. But because a lot of this is fiscal driven, and that's interest rate, it's not sensitive to interest rate. The spending, the taxation, it's largely not nominal terms. I mean, in emerging markets, when they go through issues, usually things go up in their local currency term, even if they do poorly in dollar or gold terms. And I think what we're generally seeing is some of these developed markets, especially the US, have certain emerging market characteristics, just to a less extreme degree. And so if I had a view that they were going to dramatically cut the deficit tomorrow, then I would invest differently. I would own more bonds, for example. I would own more of those types of assets, and I would own less equities and less of these other real assets. But because I don't expect them to do that, I invest the way that I do. So yeah, you could say it's bullish on the assets that I want to own if those deficits continue, but that's why I've invested in them in the first place. It's a higher nominal regime overall. Um, and it can sometimes lead to a higher real regime if you're kind of sucking monetary capital out of other countries like places in Europe or places in Asia, for example. If the US is running this playbook, but investors are still fueling it because they don't know where else to invest, the risk comes when they do feel like they have alternatives and this spending's still locked in. And so if you get to Congress, there's really not that many outcomes I see that change that, which is why I invest structurally the way that I do.
Okay. Is there a Goldilocks scenario in which the government spends money and perhaps widens the deficit, but we don't get inflation to run out of control? In other words, MMT, in a scenario in which we have stimulus, which would be good for equity markets in nominal terms, but we don't get a runaway inflation. Could that happen?
So that would happen in the context where energy is abundant, right? So a lot of new energy supply is coming online to kind of keep up with that. And two, you have deflationary offsets from things like AI or other tech. So for example, if you ran very, very large deficits, but those, for example, if you ran very large deficits, but you used it to, go get copper mines and build nuclear plants and data centers and things that were highly productive, it might or may not be as effective as the private sector, but at least you'd bring new supply online at the same time as you're debasing your currency, so you can minimize how much on a kind of a per currency basis these things are getting more expensive, if at